How's it going, everyone? Thank you for attending today's webinar. We'll be starting in a few seconds. So as you're settling in, I will present you a few housekeeping items. The webinar will be recorded, and this afternoon we'll be uploading the webinar at a YouTube page, which will give you the link as well. The presentation will be provided to all the attendees that were present today. And if you have any questions, concerns throughout the presentation, I strongly encourage you to put your questions in the Q&A option as well. In addition, a poll should be appearing pretty soon in regards of, so we could get to know more about your business and how we could tailor additional webinars to enhance your business needs. So I want to say thank you for attending today's webinar. My name is Jesus Padilla. I am the program manager of the Florida SBDC at FIU and the Pino Global Entrepreneurship Center. A brief description of the Florida SBDC at FIU: we assist small business owners to grow and succeed at no cost to you. Our offices are located in Miami-Dade, Monroe County. So if your business is located in these two counties, we are your local SBDC center. In addition, if you're located elsewhere throughout the entire state or throughout the country, by all means, shoot me an email. Let me know where your business is located, and I'll be more than happy to connect you with our colleagues from your local SBDC. In addition, we have consultants that can assist you in access to capital, government contracting, how to start your own business, or at the same time, how to look for VC investment funds as well, which is a great presentation that we have today that Ricardo will be presenting. So like I said, if you have any questions, concerns, by all means, put your inquiry in the Q&A option, and also in the chat. I'll be moderating some of the questions. So without further ado, allow me to introduce you to Ricardo Weiss that will be presenting today's webinar. Thank you.
Okay, can you share my, can you see my screen, Jesus? Okay,
yes.
Good. And are you going to end the poll, or are you going to keep? Okay. Good afternoon, everyone. My name is Ricardo Weiss, and I'm going to be talking to you about how to create an investor pitch. I know some of you may be taking this webinar because you're getting ready for the Miami Herald competition, yet I would hope that most of you are also thinking of raising funding in order to take your endeavor to the next step. So I've been around for some time, and I'm a small business owner like most of you are. I have started a number of ventures myself, but I've also been on the investor side. When my businesses were acquired, I was lucky enough to be on the side of the funders. So I know what it is to look for funding, and also the pains that an investor goes through in trying to determine whether the investment is a good fit. One of the things that you need to take into consideration as you look into starting your business, it's what type of venture you're trying to develop. And basically, you can boil it down to two paths: the entrepreneurial, what we call entrepreneurial, which really is focusing on growth, and growth is more important than profits. And that's because you are in a business that you have to grow as quickly as you can in order to get some traction. And that's what makes your business interesting. Alternatively, you're seeking to build a legacy, something that you will have and hold on to for many years, and even thinking perhaps of passing it on to next generations. In that type of business, your focus is reliable profits because you have to fund your lifestyle. So you're funding your lifestyle versus funding the growth of the company. Understanding which route or which path you're going to take, it's really very important because you need to, that's going to drive your strategy going forward. And the way you're designed and build your business is going to be based on that strategy. Doesn't mean that one is better than the other. It doesn't mean that if you build a business to find your lifestyle, that someone may not be interested in buying your business. It's just a question of what is your current focus. There's many types of funding that are available to the entrepreneur. And we're going to be focused on discussing in my presentation funding from investors. And that is dilutive funding, meaning that an investor will take a piece of your business in order to provide you with the funding. They're not interested in dividends. They're not interested in giving you a loan. That's not what an investor does. They're only interested in taking a piece of your business. So it's as you decide which path you take and whether you're going to look for investors, you have to determine whether your interests and the interests of the founders can be aligned. And what that means is that an investor is looking to exit their investment in a 5-year period. So basically from day one, you are designing and building your business to create the most friction-free exit that you can provide. For the interest of the presentation, when I talk about investor, I'm talking about the investor that invests professionally or semi-professionally, and it's accredited according to the SEC rules. SEC stands for the Stock Exchange Commission. So the government, the federal government, defines what an investor is based on this criteria. And for the sake of any discussion in my presentation, when I talk about an investor, it's an accredited investor. So what I was saying before is that your interest and the interest of the investor need to be aligned. So an investor is not looking for dividends. They're not looking for an interest payment. They're not looking to loan you money. Their interest is taking a piece of your company and selling the company in a 5-year period or horizon in order to monetize whatever investment they made. There are different types of investors. Family and friends is the first people that you touch upon. They're the ones that won't be able to say no to you because they love you and they want you to be successful. Crowdfunding is something that it was popular a couple of years ago. It's no longer really a viable way of obtaining funding, but it is still one alternative, and that's why I put it here. Angel investors are, although typically they used to be people that have wealth and would invest. Right now, an angel investor is really a professional investor that invests in early stage companies, and they're organized and they're as serious as a venture capital firm in their process.
Excuse me, Ricardo, excuse me. We can't see your slides.
I don't know why. Let me stop sharing and share again. Can you see them now?
Yes, I can.
Do you want me to start from the beginning again? Just go over the slides?
Yes, please.
So again, this gives you a little bit of background on me, and these are the companies that I either started or the funds that I participated on. We talked about growth versus profits and the difference between one and the other. And I'm sorry that you missed this slides when I first started. We talked about the type of funding. And we talked about the definition of an investor. And here you can read more about it and understand what the criteria of an investor is according to the SEC. And so we're now back to types of investors. So we have family and friends, crowdfunding, angel investors. Family offices are a large element, especially here in South Florida. And extra wealthy families, and we're talking about families that have $500 million in assets or more, tend to organize a family office that invests for the office, and it's run by professionals, and they sometimes invest in early stage ventures. VCs, venture capital firms, I think everyone is familiar with that, but a new flavor of venture capitalism is the corporate venture capital funds. And these are large companies that have decided to establish investment arms, and they look at investments on behalf of the larger companies. And the difference between the venture capital and the corporate venture is that the corporate tends to look at investments more strategically than the venture capital firms, which are really focused on return on investment. And the difference between a venture capital firm and the family offices in terms of their outlook is that family offices tend to have a longer outlook. So they're not as keen on a quick exit like the venture capital firms are. And the last element is private equity. And private equity is really focused on a very well-established commercial entities that are generating very strong cash flow and are looking for to sell out. As you set out in your path to obtain funding, you need to know the investor and what type of investments do they make. The fact that they're sitting on a truckload of money doesn't mean that they're interested in your company. So that means that every investor has both an investment thesis and an investment criteria. So you have to, part of your homework as you look into looking for funding is really trying to find a fit between what you do and the investment criteria of the investor. The other thing that you should be looking at is what type of portfolio they have and what are their historical investments. If they have not done an investment in a couple of years, they're probably not going to make any further investments, because typically investors that are professional investors take investment from other investors and they invest those funds on behalf of the other investors, and they close. And that's when you read about a closed fund, which means that the fund is closed for investments, and what they're doing is really farming their current investments to provide a return to their investors. So the investor criteria includes, who the management team is, and what type of service or product the company is going to provide, what is your market differentiation, how large is the market, how scalable are you, and what would be a viable exit strategy. And they take those elements into consideration, as well as geography and the type of investment structure that you have. So that means, for example, that there are funds that will only invest in South Florida. There's other funds that will not invest east of the Mississippi. There's other investors. So their geography is an element. The stage of the company is an element. And the marketplace in which the company is involved in is another element. So those elements are part of the investment thesis. For example, when I was doing investments, I did not invest in social media, and that was when social media was hot. So it didn't matter how great the idea, the concept was. If it was a social media play, I was just didn't meet my investment thesis. So I couldn't make that investment because as an investor who's investing on behalf of other investors, I also have to tell them when I'm raising those funds, what is my investment thesis and what my investment criteria and when I'm going to return the money to them. So I have to comply with that. So how do the investors invest? They have a process in place. Basically, when you submit a pitch or a business plan for consideration, they will be analyzed on first hand by financial analysts that weights the plan against the investor's criteria. So they do that on a scoring mechanism, which is, by the way, the same way that the Miami Herald, the FIU portion of it works. We also score all the plans based on a scoring mechanism based on criteria that was pre-established. In terms of the VCs, less than 10% of the submissions actually make it to the next round. You know, they see tons and tons of plans. So it's really important to make sure that you meet their criteria so you don't get discarded on from the get-go. Understanding what stage your company is at is also important because there's VCs that do not invest in pre-seed or younger companies. There's VCs that only invest when the company has shown maturity and that they have some traction. So knowing the stage of your company and knowing where to go for funding is important. So I know of great companies with great concepts that are trying to get VC funding and they're getting turned because they don't meet the minimum criteria in terms of volume of sales. So and not every VC has the same criteria. So as you look into designing where you're going to send your pitch deck for consideration, that's another additional element. The one thing that is important about this slide also is that getting those initial $25,000 to which is the average that it costs to develop a minimum viable product and developing your business plan is not that difficult. Most people are able to run that kind of money from family and friends. The hardest of all the stages is the pre-seed. It's okay, you have your minimum viable product, you have business plan, and you need to prove that the concept works. How do I do that? And I need more money for that. And typically that may go anywhere, it may cost you anywhere from $75,000 to $250,000. And getting that money is the hardest, and that's where most companies fail. So now that I've talked a little bit about the marketplace, let me talk about how to build a pitch deck that will get through the selection process. there is evidence that the decision whether to review a deck or not is taken by the person receiving the deck within the first 30 seconds. So what that means, and I've been in those shoes, is that, you know, when I'm sitting down to review decks, I'm not reviewing those decks as they come to me in the email or by going to the system to look at them. I let them sit and I put aside maybe 3 or 4 hours at a time where I'm going to sit and just review all the decks that I have, and I might have 20, 30 decks to review. So I'm not going to go through a deck if in the first 2 pages it doesn't make me feel that the deck is going to be attractive to me, whether it doesn't meet my criteria, doesn't meet my thesis, or it's just not well prepared. So I bring this to you because the first couple of slides of your deck are immensely important. This is what a typical deck should include, and it's not obligatory that you do it in this sequence, and it doesn't mean that it has to have all these sections, but most of the sections have to be in there. And I highlighted the ones that are critical in the decision-making process, and I'll go into more detail as we go along. So the first slide is really the cover slide, and it just has the logo or name of the company. It has, you know, what is it that you're doing? This is an investor presentation. I will always recommend that you keep a date and version number on the cover slide. And the reason I do that is because these texts tend to be living documents. As you get feedback and meet with more people, you're going to want to add more information or change information or update information. And you really need to track which version of the deck did you distribute to any given party. So keeping track of that is important. The first real slide of the deck is the executive summary slide. It's also called the 30-second pitch, and it's basically a brief, succinct description of what is it that you are doing. And this is the make or break slide. If you don't have a strong slide here, you know, then you run the risk that the analyst or whoever is reviewing the deck is just going to discard it, give you a low point and just throw it into that digital waste basket. The next section talks about the market problem. What is the pain point that you're trying to resolve? What is it, you know, what is it that you're trying to do? Why are you here? How large is that market? You know, what is the market opportunity? And we're talking about the addressable market. And let me go to the next slide. So it's important you understand the difference between addressable market and total market, because the investor is not interested in the total market, but really, you know, the market that you can address. And the best way that I can explain this to you is that, let's say you're trying to do a bakery, and you have the best croissants in the world, or you believe you do, and you wanna sell them in the Brickell area. Well, you know, if you look at the total market, the total market for croissants may be in the hundreds of billions of dollars, you know, but the reality is that if you send in your bakery in Brickell, even if the total Miami market is large, people are not going to drive to Brickell just to eat your croissants. So your addressable market is really the people that are in a walking distance from your bakery. So that's what becomes a total addressable market if you translate that into your marketplace. The next section that you talk is about what is your solution? What is it that you're creating? What service or product will be you're developing that will resolve the pain points that you described and have a fit within that addressable market that you have identified. The next area of the deck is really about the team. And I cannot stress how important this is. As an investor, to me, the team was more important than the concept or idea. I had a co-investor that once said to me that a great idea with a mediocre team is not as good as a great team with a mediocre idea. Because a great team will always make that mediocre idea a great idea. Whereas if you don't have a great team, you can just bomb that great idea. And I've been in those shoes. I know from personal experience. So what a great team also means is that you, at least from my perspective, is that at least you have team members that have industry expertise in your vertical business. You may or may not want to include members of your board and advisors, but I would only do that if they bring value to you. And here a word of a tip: do not put in advisors that have not signed up to be advisors. And again, that's happened to me. I've done due diligence on companies and I call the advisors and they say, well, I don't understand. I never gave permission. So that's a red flag. So just be aware if they're going to lend their name to your company, they really need to be aware of that and be willing to give that advice in that role. The next section that you should be discussing your pitch deck is what type of traction do you have? What is your timeline and what key milestones have you achieved so far? And that's why this deck changes all the time, because as you achieve milestones, you want to be able to display those on the deck. Sorry, it's not COVID, so don't worry. Market landscape competition. I've been in situations where people say, well, I don't have any competition. Well, if you don't have any competition, there is no market. So there's always got to be competition. And whether they're direct or indirect, you're always competing for that same traction or dollar from your consumer. So understanding the decision-making process, the purchase decision-making process is important, and being able to portray it in a competitive landscape is important as well. And there's different ways of doing that. So I'm just going to share a couple with you. One is the axis chart, where you would compare yourself to other competitors in your category based on a couple of attributes. And I chose here value and uniqueness. And this was an easy one because you have Apple here, which is, it's perceived as very unique, but also as a high value proposition in terms of a cost. Another one is, and this one you may be familiar with, is it's a matrix chart where you compare your company against your competitors on a series of attributes. And you can choose what those attributes are. And this is the preferred way of doing it. And then you can also use a SWOT chart for that purpose. And as you know, SWOT stands for strengths, weaknesses, opportunities, and threats. Once you've identified your competitors, it's also important to identify what makes you better than your competitors. So if you need to take another slide just to make sure that you harper this point and just go into more depth, do that. The next section is about the business model. And the business model is how you plan to make money. If you're software and it's going to be based on subscription, then how is that subscription going to be based? If you're doing another business model, you need to explain that to the investor. And that also means having a good understanding of what your customer acquisition cost is going to be and the life expectancy of that customer. So business model is a very important section of the deck. Many people do not include it. I urge you to do so. The other section that a lot of founders forego is taking the time to understand how they plan to take their product to market. And you know, I don't know how many countless times I've sat down with founders of companies that spend 100% of their time trying to develop the product and the features of their product, and do not spend any time figuring out how they're going to make that product visible to the possible consumer or buyer of that product. So having a good understanding of how you're going to take that product to market is very important to the investor. It has to make sense. You have to spend time figuring that out. This is the what, who, where, when, and why of your product. So the next section is about financial projections. And the intent here is not to add a whole Excel spreadsheet into the deck, but it's really summary financial projections. And what that means is that you have to work out those financial projections separately on a very detailed basis on an Excel and just pull out the summary information into the deck. But you need to be able to discuss this, because the objective of a business plan or a pitch deck, no investor is going to make a decision on whether they're going to invest or not just based on the pitch deck. They're really going to make that decision based on a number of conversations that they're going to have with you. But the first decision that they're going to make is whether they're interested or not. So the objective of the pitch deck is really having that basis for an initial conversation. And so you're just going to summarize the financials. And the way you do that is with a summary similar to this, where you're projecting 5 years out, and it's just top line financials where you have your gross revenue, your cost of goods sold, which gives you your net revenue. What are your general and administrative costs? What are your salary and benefits? And what are going to be your marketing and sales? And that's going to give you an NOI, which is a net operating income. One of the errors that a lot of founders do is that they show that they're going to be profitable from year one. I wish I had a dollar for each company that says that, but having put that aside, if you're going to be profitable, then you don't need any money. The only reason you would solicit investor funding is because you're going to have losses or a negative net operating income during the first years of operation. So the investor is looking in understanding and accepting of the fact that they're funding the delta between your net operating income and your revenue. So not your revenue and the money that you need. So they're going to be funding basically your net operating, your negative cash flow, and that's what they're willing and accepting of doing. But if you don't have a negative cash flow, there's nothing to invest in. The next section of the deck deals with the capital raise, how much money you're seeking and how you're planning to use that funding. Another thing that has changed in the last few years is that years back you would look for funding to provide you with probably the first 12 to 24 months of operation. And nowadays, investors invest with shorter time spans. They're looking to fund maybe 6 months of operation at most, with the hope that you reach your milestones and then they give you additional money. If you don't reach those milestones, it minimizes the risk, and that's the end of the story. So raising funds becomes a time-consuming, but also a process that it continues through the lifespan of the company. Adding an exit strategy is optional. You will read about people that don't think it's necessary to put an exit strategy in your pitch deck. Other people will ask for it. My point, this is optional. My point of view is twofold. First is, if you understand what are the possible exit scenarios that you may have, it helps you develop the appropriate strategy for your company. And secondly, it also shows the investor that your thoughts are aligned with his or hers. So by portraying, talking about a possible exit, you're saying to the investor, yeah, I know that this is what we both want to achieve within a time frame. As much as I try to think about it, there's only 5 possible scenarios for exit. An IPO, which is mathematically almost impossible to achieve. And there's maybe 150 IPOs per year. There's about 400 to 600,000 companies that get started every year. So the chances of doing an IPO are, I think, just about equal as winning the lottery. And so the focus really about in terms of the possible scenarios is because you have a really unique technology that is appealing to the buyer, and they're interested in your technology more than anything else. It's your traction. You've been able to get tons and tons of subscribers, and whether they're paying or not, they're using your software on a regular basis, or are they playing your game on a regular basis, or are they buying your product on a regular basis and recurrent basis. That's the traction. Revenue, that's an older model. It's how much money the company is generating and how much free cash flow it will generate. And the last one is acqui-hire, which is basically they're interested in acquiring you, not because of the product or the concept, but because of the team that is working in the company. Having a closing slide is also optional, but I think it's an opportunity to give the presenters some opportunity to talk about some future opportunities, some blue sky thinking. It also provides the opportunity to summarize the key takeaways. So I think it's a benefit to have it, and I strongly encourage you to have it. So some additional guidelines, will be ending pretty soon. So some additional guidelines are, limit your decks to 15 to 30 slides at the most. Try to, if you're going to be presenting the deck, personally, typically they will give you 10 minutes to present. So, limit the slides based on that, taking into consideration that it will take you about a minute per slide, maybe 12 slides at the most, 15 slides. Try to be very succinct and focus your presentation like I did on bullet points. It should be simple. It should be self-explanatory as much as you can, and use very large fonts. People should not be, needing to get up from the chair to see your presentation better, especially if you're giving it in a conference room or in an auditorium. When you're pitching personally, introduce yourself like I did. Try to grab attention early on. Tell your story as much as you can, and don't switch between presenters. It should be the CEO presenting in most cases. Make sure that you don't read the slides. You should be prepared to talk through the slides. People can read them themselves, so you don't have to repeat what's on the slide. And don't show videos or demos if you're talking to larger groups. Some words of wisdom: try to focus on your customer's main problem, not multiple problems. Prepare yourself for rejection. It typically will take you maybe 50 to 60 pitches before you get any traction with investors, but try to understand why they decided not to invest in your company, and try to do so in a proactive way so you can learn and you can carry it on to other presentations. It's all about execution. It's not about the idea. Some myths. My deck is so good that I don't have to include a go-to-market strategy. I can tell you that if you don't include a go-to-market strategy, you're not going to get funded. If you do not include a go-to-market strategy in your deck to the Miami Herald competition, you're not going to make it to the finals. You have to include the financials. You have to include the management team. And management team doesn't mean putting a picture, a face picture, and your name. It means putting bullet points of of who are you in terms of bringing some value to the company. And remember that a deck is about telling the story of your company. So make it attractive, make it interesting, and tell the story well. And as a final comment, and I've lived through this many times, everyone has a plan until someone gets punched in the face. And that was a words of wisdom by Mike Tyson. I always include this in my presentations, because as an investor, it doesn't matter how many assets a company has, there's something that always will go wrong. So, thank you, everyone. My name is Ricardo, and you can write to me if you have any questions after this presentation. I'll try to answer the ones that I can here.
Perfect. All right, Ricardo. I have a few questions for you. How important is the investment slide? Are there any recommendations on where to pitch?
And where to pitch? So there's a number of events in South Florida that cater to people pitching plans. But it's not about where you pitch, it's really about who do you pitch to. So if you really are serious about getting funded, you have to spend time, like I said at the beginning of the presentation, trying to match your company to the investment criteria and thesis of the potential investors. And it means identifying those probably through Google, but another way of doing that is by looking at similar companies to yours and understanding who provided funding for them. And that will be a good first step.
Perfect. And then another question, advice for companies that have already succeeded in the initial pitches and funding. What modifications or pointers would be recommended for a later stage pitch?
So the structure of a pitch deck is still the same, but you would, in terms of the information that you provide, would also include historical information. So you're not talking about, I will do this, but it's, we've done this and we've been successful, and this is what we're trying to do now. So for example, in the financial projections, in addition to the 5-year outlook, I would include a couple of years of historical data. In terms of the milestones, I would include milestones that have been achieved already, as well as milestones that we're planning to achieve. In terms of the product and ideas, this is a product roadmap that we have. You know, this is what we've done so far, and this is what we're trying to achieve now.
Okay, and then what areas do investors prefer to cover when speaking to them? How long per area?
What areas of what? I'm sorry, I need more.
Yeah, like I guess like key parts of the pitch deck where
so again,
captivate their attention.
So the pitch deck is really, like I said before, it's really the mechanism or the vehicle that you use to have that initial conversation with the investor. And they're gonna be asking you questions in the areas where they want more information on. And you have to be ready to address that. And one way you can do that is either by having, if you're meeting one-on-one, is by having supporting slides, additional supporting slides. Or if you're gonna, he's gonna ask you questions about the financials, then you should be able to address those in the Excel spreadsheets. So by the way, a number of companies come to me and say, well, can you help me develop the financial projections? But if you don't own it, you don't know it. So I always push back on those items, because if you know, you need to develop your own supporting materials, because if you're not familiar with that, it's going to come through in any conversation that you have with investors.
For a university early stage startup, how many slides should be included and type of financials?
So whether you're coming off the gate or have some history with you, the structure of the deck is exactly the same. It's just the type of information that you're sharing in terms of your outlook. So you're still looking at 5-year projections. You're still looking at you know, what is it that you're trying to achieve. Obviously, you don't have as many milestones as a company that's already been in the process for a few months. But and that's where knowing what stage of the company you are in is important, and knowing what type of investor is going to be looking at that stage of company. So a VC is not going to be interested in talking to, you know, to college grads that are just coming, you know, out of the university, just because they don't have any traction and they don't have any, you know, any historical data to share, and have not achieved the milestones that a VC are looking for. But there is a number of incubators and accelerator programs that will talk to them. So it's finding the right fit for the stage of your company.
And I have a healthy drinks company, where do you recommend for me to look for as investors?
So you the answer is that you have to look for investors that have invested previously in healthy type of foods, preferably even in healthy drinks, and there's tons of them in the marketplace. So it's it's the way I do it when I'm doing it myself is that I look at who my competition is. I go in and try and understand who and where they got their investments from, and try to research those investors and try to approach them. The fact that an investor has already invested in the area makes them more interested and more knowledgeable about the space. So it's an advantage. It doesn't mean that they're not going to invest in a competing company.
And then any advice on company valuation? Is it based on revenue or technology or both?
That's a difficult question because it's based on multiple factors, and valuing a company at a very early stage. Once a company becomes a little bit more mature and has some commercial viability, the process is more objective. But until then, it's really more an art than a science. And basically, to me, the biggest driver is comparables. And by comparables, I mean companies that are trying to raise funding in the same geographical area at the same time with a similar type of product. It doesn't have to be a competing product, but if it's software and it's a it's a company that's just starting off the gate and they're based on Miami, I'm going to I'm probably have another 10 decks that I'm sitting on and looking at, and we're going to compare the valuations and see whether they're aligned or not. And at the end of the day, if I'm interested, it's going to be a negotiation. Now, you can easily price yourself out of the market, though, if you're too greedy.
Yep. Yeah, that's the thing, is like you have to find that sweet spot of the ideal clients and at the same time give and take based on the owner equity for the investor. And
I do another presentation which I on this subject area, and there's a couple of points that help you with the evaluation process. One is that for a very early stage company, and I'm not talking about one that already has a commercially viable product and it's doing their second or third round of fundraising, but a company that's starting, an investor is typically looking at getting back $20 for every dollar that they invest. So if I'm an investor and I'm investing $1 million and I don't see the potential of getting $20 million back, I will not make that investment. And how do I know I'm going to get $20 million? Well, basically, the rule of thumb is that an investor with every round of investment takes about a third of the company. So I know that the company has to have a value of about $60 million in 5 years. And how would I know if that company can possibly get to those 60 million? Well, I'm going to look at the financials and I'm going to see what the financial projection is for the end of the 5th year. And if they're not generating $60 million in revenue, I know that the company is not going to be worth $60 million. Bottom line.
I have a current pitch deck formatted as bullet points, but I had it reviewed and was told to put my problem statement text and text on other on some slides as a paragraph. What would you recommend?
So it's a good question, and there's something called an investor deck and something that is called a pitch deck, and people use those two terms interchangeably, but they do not mean the same thing. An investor deck is a deck that is designed to stand alone. So it means including, in addition to the bullet points, including a little bit of a write-up to explain, that further explains the point, so whoever is reading the deck can understand what they're reading without the presence of the person presenting the deck. The pitch deck, on the other hand, is a deck that is designed to be a walkthrough. So it's designed so the presenter is talking through the points and not including all of that information on the deck. You're gonna, at the end of the day, as a founder trying to look for investments, you need to be able to have both of them. And really, at the beginning, there's no reason why you can't combine both into one single deck. So you do have those bullet points, but you have one or two additional lines that explains further the point that you want to make. A long answer to a short question. Sorry.
Should we include a slide with testimonials as a social venture? Should we include a slide with impact data? You
need to add that information on the traction slide. That's where you would, if the traction that you're getting is through social media and that's information, feedback that you're getting, then you would include that information in the traction section of your deck.
Okay, and then I have one last question here. I'm the founder of UGOBE.io, an out-of-home advertising company specializing in digital walking billboards that display positive ads to uplift communities. My question is, what type of investors would you say would be interested in my company?
Investors that invest in advertising or marketing ventures.
And then also just some final housekeeping items. Ricardo was talking about the Miami Herald Startup Pitch Competition. This is a yearly competition that the Pino Global Entrepreneurship Center participates under the Miami Herald. And Ricardo is one of our judges. So if we have any FIU affiliated alumni, faculty and staff, students, we strongly encourage you to participate in this year's challenge. I will be personally sending you an email with the rules and regulations to participate. If you're not affiliated to FIU, that's not a problem. There is the community track as well. And I'll be more than happy to give you the necessary information for you to participate. This is a great competition. As such, we've had some successes. As such, one of them, like what Ricardo was talking about, the scalability and the projections. One of our finalists, they ended up getting over $1 million in seed funding, and they became the 14th ever African American women-owned small business startup to obtain these that venture. So it's a good opportunity for you to participate, network, get feedback from professionals on your pitch deck. So we will be more than happy to assist you. But at the same time, the video, today's webinar will be uploaded on our YouTube page, and also the slides will be emailed to all of the participants as well. So then, yes, I will be emailing you all with all the 3 key points, with the slides, the YouTube link, and also the requirements and the link for the Miami Herald Startup Pitch Competition for the general public, for the community track, and then also for any FIU colleagues of ours that are in the FIU family. Strongly encourage you to participate under the FIU track as well. But like I said, if there's any questions, concerns, don't hesitate, give us a call. We're more than happy to assist you. We're family. And without further ado, I'll be looking forward to seeing you at the next webinar. Take care and have a wonderful day.
Thank you. Thank you, everyone.